It's time now for a look at the day's top business news with Brian Quinn. Good evening, Brian.
Hello, Sonam.
You're starting off in China, where a 3-day summit to promote the country's massive Belt and Road program's getting underway, and there's a great deal at stake.
That's right, Sonam. The Belt and Road, of course, is China's multi-trillion-dollar global infrastructure initiative. The brainchild of President Xi Jinping, it was launched in 2013 to expand commercial links between Asia and Europe and build new ones around the world via major development projects. Critics now call it just a means to spread Chinese influence abroad, saying expensive projects are drawing poorer countries into debt traps. Those are concerns Beijing is seeking to address. Owen Barnell reports.
World leaders are flocking to Beijing as the Belt and Road Summit kicks off. 37 are expected to witness China's flagship infrastructure policy take its next major step. For Beijing, it's a chance to address a growing international backlash. One criticism of the plan: countries buying into the scheme are often saddled with unsustainable debt. Beijing says it plans to work with participating countries to make sure they can afford to borrow. The UN says progress is being made.
I've seen China quite active in finding solutions of different sorts, forgiving debt, transforming debt into equity, and a few other measures, which shows that China is very attentive to the fact, and as I said, that there is a global debt problem.
The Belt and Road Initiative has added complications for European Union relations. It's an opportunity for EU leaders at odds with Brussels to break ranks and look to Beijing for support. One major coup for Xi: Italy became the first G7 nation to sign up in March. Total costs of the initiative already stand at $3.6 trillion. In China, it's being termed the project of the century. To critics abroad, it's an attempt to cement Chinese influence around the world.
Brian, you've also been taking a look at a massive banking merger in Germany that's actually been called off now.
That's right. Deutsche Bank and Commerzbank have ended those merger negotiations. Germany's two biggest lenders announcing that benefits from the deal would not be enough to justify the extra capital and restructuring costs required, nor the risk. The German government was in favor of a merger to avoid a foreign takeover of either bank, but investors and unions alike had serious doubts. The deal could have cost over 10,000 jobs, and with both banks still damaged from the financial crisis, analysts warned that two weak halves wouldn't necessarily make a strong whole.
And how are the markets looking this Thursday?
Well, shares in Deutsche and Commerzbank headed in opposite directions on that latest news. Deutsche up about 1%, Commerz down around 2.3% at midday. European indexes overall in the red at midday Thursday as investors track a flurry of corporate earnings reports. Sainsbury's shares down over 4% in London as a merger with fellow UK supermarket chain Asda is blocked by regulators. The FTSE 100 down just under the flat line there. The CAC 40 here in Paris down around 0.1%. Bayer shares are up over 3% in Frankfurt on rising earnings despite significant risk from cancer lawsuits after its acquisition of U.S. agriculture firm Monsanto. The DAX, though, still down just under the flat line as well.
Brian, another story that's been getting a lot of traction is the medical marijuana industry that's expanding here in Europe.
Yes, a Canadian firm Tilray has inaugurated its first European cannabis production facility. The 76,000 square meter farm is located in Cantanhede in central Portugal. It represents a €20 million investment and roughly 100 new jobs, with 100 more expected by year-end. Tilray exports to 13 countries, including Germany, Croatia, and the Czech Republic. CEO Brendan Kennedy says it's looking to expand that list to include Ireland, the UK, and one day France. Portuguese officials hailed the new facility as a win for the country's economy.
We're talking about making a foreign investment oriented towards exports that creates jobs. It has great potential for development with the help of science, technology, laboratories, and universities from across the country. It will also allow us to create opportunities to promote talent.
Some more of today's top business headlines we're following for you at this hour. Facebook has earmarked $3 billion to cover a potential fine from U.S. regulators over privacy violations. Federal Trade Commission launched its investigation into the social media giant following the Cambridge Analytica data sharing scandal. Facebook says the final cost of a settlement could hit $5 billion. Tesla has posted a $700 million loss for the first 3 months of the year. CEO Elon Musk says the company may seek to once again raise outside capital, with smaller losses also predicted for the second quarter. Tesla's struggled with deliveries of its mass market Model 3 sedan and slowing sales of older models. And Kering is reportedly nearing an agreement with Italian tax authorities. Reuters says the French luxury group is likely to pay between 1.3 and 1.4 billion euros to settle unpaid tax claims against its Gucci fashion subsidiary. Kering had previously contested those claims, but a settlement spares it from additional sanctions and interest that could have added 500 million euros to the total.
Brian, let's shift the focus to France, where farmers have been complaining that a recent law aimed at raising their incomes is actually failing even to help them put food on the table.
That's right. France's new food price law was approved back in October. It bans retailers from running 2-for-1 promos and requires them to run 10% profit margins. That with the goal of sending more money back to small producers. But the law doesn't actually require those prices to be passed back to farmers, many of whom now say they've yet to see any benefit at all.
France's new food laws were supposed to help farmers. Farmers who spent years calling for more to be done to improve their situation. Yet for many, the wait goes on.
We had a lot of hope in the beginning. We really thought our production costs would be taken into account, and that would revalue the price of our cattle, but nothing has changed.
The price of meat has not gone up. In fact, it's gone down to €3.60 per kilo.
It must be minimum €4 per kilo for animals like these to cover the costs of production.
The law intended on helping smaller producers in two main ways: ban promotions in shops, like buy one get one free, and increase prices on big-name food and drink brands, meaning they could no longer be sold at cost price. It has had an effect. Promotions have disappeared from shop shelves and prices have risen by 4% on average, but the extra money has not ended up in farmers' pockets. So where has it gone? Both distributors and manufacturers accuse each other, while the government is refusing to pin the blame.
I think that today it is slightly too early to judge a law that was only brought in on November 1st, 2018. It's been less than 6 months since then.
France's farmers hope that in time, this law intended for their protection will finally bear fruit.
Thank you for that update, Brian, and thank you for watching. Stay tuned.